Okay, good morning everyone. This is the brief for 29th of September, last day of this quarter. As we've seen in the past and as to be expected, you'll generally see, you may see a bit of volatility coming into the last days of the quarters as you see fund managers and asset managers start to rebalance their portfolios going into the last quarter of the year. So I would be mindful of that, especially coming into the afternoon session when volume generally picks up. Now, on that note, it would also be worth noting that statistically speaking, the second half of the year generally sees an uptick in volatility, with generally we see declines in the equity market. I'm not saying that will be the case. If we look at equity markets for the past few weeks, I think once again we can see sheer amount of optimism in the economy, but I would be just careful of an uptick in volatility, given the fact that it's the last day of the quarter coming into the home straight till we reach 2018. So just having a look at the charts this morning, it's been relatively quiet, but one thing I wanted to quickly talk about was we had Mark Carney speaking earlier, and his comments were so BOE Mark Carney continues to stick to yesterday's themes on central banking independence, speaking on largely historical basis, continue to highlight the risks of Brexit and household debt, reiterates that hikes will be gradual, which is a key point there. Now, it was the fact that he reiterated it, but nevertheless him speaking, we saw a bit of volatility, cable breaking below the Asian session lows, quick rundown, not really getting to pivot, but ultimately reversing and just back to test session lows. So I'll be keeping an eye on sterling, but this is nothing new here. He's not going to be too hawkish with regards to any impending rate hikes. There's another little move here in the morning, which was to do with Volkswagen. Says will increase provisions for recall action in North America, adding a Q3 negative special item of around 2.5 billion euros to be expected. So this just saw the Volkswagen shares drop by 2%. We did see some immediate downside in the DAX, which happened around here, but it wasn't really sustained. I did try to get into a short around here. Around this level here, didn't really carry through to anything. But other things to note is just what we saw yesterday. So yesterday was relatively quiet. We had some headlines, which were your German inflation numbers and Spanish inflation numbers. Both were just a slight miss on expected. Germany at 0% versus 0.1%, Spain at 0.6 versus 0.8%. So these numbers, just a slight beat, and what we did see was this started to sort of stop this optimism which we were seeing in the beginning, where we saw this continuation of the Trump trade. So we bring up the charts here. We're seeing coming into the morning this dollar strength as we're seeing this continued optimism with regards to Donald Trump's tax plans, and as a result of this, as a result of also the euro area confidence numbers, we managed to break back above pivot, and ultimately the day was very, very quiet coming into the afternoon. There's a couple of the live guys I saw were complaining about how choppy it was, and indeed it wasn't very fun to be trading yesterday afternoon, but a lot of that was due to the fact that we have quite a busy day on the calendar today. We'll be going over that shortly. Another notable move loss yesterday was oil, which fell 1.1% yesterday. It was quite an aggressive move lower here. This sort of timing-wise coincided with, from its highs to its lows, there was an intraday swing of 3.18%, so quite a volatile day. This sort of, what we saw yesterday was this move was going down roughly the same time where we heard Iran talk about leaving the nuclear deal. Now, as Max was saying, this should be positive for oil prices, given the fact that there'll be more sanctions, less supply from Iran, then oil prices go up. So I was speaking to Anthony about that, and he said actually the decline in oil prices had already begun before the headline was run. If anything, a bit of profit taking, plus the fact that I'm sure there's enough people in the oil market who are quite uncomfortable with the oil trading at 42.80, given the fact that we're going to see shale oil production start to ramp up higher as the effects of the hurricanes and energy traders start to look at that data a bit more closely. So this was a notable move, ultimately coming down, finding support on this S2 level, which loosely, well, not quite, but you can sort of coming up to test the top of its previous ranges. So we keep an eye on the oil market today. right now just seeing the previous low of the range really defining the top end of the current consolidation post this move, 51.63 being that level at the moment. Okay, otherwise looking at the headlines today, what we're seeing is people starting to speak about the Spanish situation in Catalonia. So just on a quick note there, this is Catalonia is having their independence referendum on Sunday. Now this is not going to be legally binding as it's a referendum, and Spain is generally going to shrug this off, but I think what Bloomberg is saying and some of the analysts and the investor community is saying is that this will inevitably result in political and economic uncertainty. Catalonia being quite economically important for the Spanish economy, ultimately making up about 20% of their output. To see such infighting within a country will inevitably result in a bit of political and economic uncertainty, which then would go and have a negative impact on the Spanish economy as a whole. So this is now picking up some steam, and looking at some of the numbers run by DB Reid, what they were saying is that 3 years ago there was a non-binding ballot that showed 80% of people supported independence. However, that was only the view of 30% of the ultimate turnout of people in Catalonia. Now I do notice that we started the brief a little bit late today, so I'm going to be wrapping up relatively quickly. There's a couple of things I wanted to talk about apart from sort of the data of the day ahead and the day so far, which is the euro-dollar currency pair, which has been one of the best products to trade this year. It's been so directional. We've seen hawkishness come out of the ECB, and we've seen US inflation plummeting, coming from 2.9% all the way down to sub 2% below the target rate, which caused optimism in the euro, and the euro started gaining while the dollar continued to fall. And we've discussed the dollar index previously and how it's come off quite heavily since the first trading day of the year. So this really clean unidirectional move since the beginning of January over here, there's been nothing to stop this going higher and higher and higher. We continue to see positive European data. We continue to see low inflation prints. We saw Yellen turn dovish sort of mid-year, and now she's obviously, we're going to discuss what's been happening most recently up here. But for most part, it's been a unidirectional trade. This has been a great product to be trading. There's fundamentally supported, technically going for those extensions, extension of the moves higher, catching the pullback, going for the extensions. But most recently, what we can see is this move is starting to lose a bit of steam up here, where we consolidated around this 1.2 level, and now it seems like we've broken back below here, and now we're just losing steam. Now, why is this? Well, this is because that low inflation numbers from America haven't continued to decline quite as fast. They started to stabilize around the 2% level. We've seen Yellen talk about how we need to, inflation is symmetrical, we should be as tolerant to the downside as we are to the upside. And basically reiterate the fact that shrinking of the balance sheet and hiking once again this year is on the table. So we've seen the dollar strengthen as a result of this, whilst we've continued to see relatively positive data coming out of the Eurozone, as well as hawkishness from the ECB. So what was a twofold move with euro strengthening and dollar weakening is not so clear anymore. So this favorite trade for the year is now starting to become less favorable as we're continuing to see euro strength and dollar strength. So I'd be careful of this, but what other opportunities does this present? Well, this presents the fact that we had European equity markets underperforming against American equity markets this year. Even though we've seen the soft and hard data start to improve in the euro area, and this was because the euro is getting stronger against the dollar. So what we may see coming into the end part of this year, and most probably in 2018, as one of the banks was also discussing in DB Reid, is the European stocks are going to be outperforming for maybe the rest of the quarter or next year. And this is understandable as the euro comes off some of these elevated levels against the dollar. It'll make it more competitive in the global markets, and we'll start to see sort of your euro stocks and maybe your DAX start to outperform, aided very much so by this euro weakness. What is worth noting is even though the euro has been rallying so hard, it's not like we've had it's weighed on any of the soft or hard data sets. Maybe we could say with the German a slight miss, but I don't think that's anything considerable for now. Okay, otherwise, coming up to 9 o'clock, I just wanted to have a quick look at the calendar ahead. It's going to be a busy day today. We've had German unemployment just come out. Unemployment rate 5.6 versus 5.7% expected. This is, even though it generally should be, some people may think it would be market moving, but we know the German economy is nice and strong, so no real reaction in the euro. Just having a look at the DAX here. No real reaction there either, maybe coming off some of its best levels there. Coming into 9:30, we're going to see UK GDP growth rate Q2. These are going to be a final reading, so lesser relevance. Just having a look at the charts here. Looking at the year on year, yep, steadily declining as the year has gone by. Expectations for 0.3. This is higher than the previous of 0.2. However, year on year, 1.7 versus 2% previously. But final reading is going to have limited impact. I think still going to be listening out for any commentary from Mark Carney or any of the Bank of England speakers to give us a direction in sterling. As the afternoon progresses, the morning progresses, we have 10 a.m. Euro area core inflation rate year on year flash reading. So these being flash readings should hold some significance. However, we would have already had our German and French and Spanish inflation rates. So the euro area inflation as a whole comprises of German, French, Spanish inflation. So because we've already started to we've already priced in the lower German readings and Spanish readings, and this will have a lesser impact. Still be, I wouldn't get too complacent on it, but no surprises if this is a slight miss on consensus, given the fact that we've seen German and Spanish readings come out a bit lower. But still don't want to be holding any trades in euro or DAX coming into this. Following the day on, we start to see quite a bit of US data come out here. Broadbent speaking at 1:30. This sort of coincides also with the fact that we have core PCE price index, so your core and your headline coming out. So the PCE, as the Fed continues to state, is their preferred measure of inflation, so it'd be important to keep an eye on this. Let's look at our year-on-year headline number over here. So as their preferred measure, it has been steadily rising. This is more likely going to see a continuation of this move higher, month on month. Just looking at our headline here. Once again, nice steady uptick here. So even though the headline has been pretty whippy, their CPI numbers, their PCE numbers are looking steadily increasing month on month. But what I think on this data is going to be more important is your personal income month on month and your US personal spending month on month. As we've been continuing to hear on Bloomberg, people have been talking about the Phillips curve, and this is basically just saying there's an inverse relationship between inflation and unemployment. So if unemployment increases, inflation will go down. If unemployment decreases, therefore we have more employment, inflation will pick up as people have more money, or well, sort of power shifts because there's more competition for jobs, so you'll have to see employers pay more to retain and retain staff and to attract new staff. And as they pay more to retain and attract, this gives people more money. People have more money, they have more spending power. More spending power, there's more demand. There's more demand, then filters through into inflation. And because there's inflation, then they demand higher prices, and they demand higher prices, they get more money, more purchasing power. And this concept that as we get more and more employment, we should start to see an uptick in inflation. But this hasn't been the case recently. This hasn't been the case for the past few years. We've seen every single month beats on the jobs numbers. But average hourly earnings haven't really been picking up. So this is another measure of sort of earnings, your personal income and your personal spending month on month. So it'll be interesting to see how these numbers come out. So I'll be keeping a close eye on personal spending and personal income. It's personal income sort of been on actually quite a downwards trajectory at the moment. But then as this is an employment number of sort, I'll still be taking this with a pinch of salt, given the fact that we have had the hurricanes in America. And then 3 o'clock, US Michigan consumer sentiment. These are your finals for September. Expectations, these are your finals. Still be keeping a close eye on these numbers. 3:15, European ECB, Euro area ECB Draghi speaking. 3:45, BOE. Mark Carney speaking. So busy on your speakers as well. We've got the head of the ECB and the head of the Bank of England speaking. And then finally 4 o'clock, Fed's Harker speaking as well. So it's going to be a busy afternoon. We're going to have some data sets coming out in Europe in the morning. So we should see some more interesting and tradable price action than what we saw yesterday afternoon. So I'd sort of be careful this morning. Just hold fire, wait for the best technical points of entry, because this afternoon should be quite busy. But just so that as a point of note, I'd also say, being the final day of the quarter, you may see some increase in volatility and some choppy price action as people push through big orders as they're rebalancing their portfolio. One thing I would say as an example is, let's say people were long US equities for this whole quarter. Well, they would have done very well on that one. Very well, it would have been a steady incline upwards. So maybe they're looking to book some profit or rebalance, maybe think the tech sector is going to outperform. So you may see the S&P sell off and the Nasdaq rally, or people think that your industrials are going to improve, so they're going to sell technology and put money into the Dow. So your correlations may break away and you'll see sort of individual bouts of volatility in certain products as investors may look to offload some positions and then reinvest and rebalance their portfolios in other assets. This will be the same for gold, oil and FX. If people think that the euro is now going to underperform relative to sterling, then what we will see is we may see a correlation play between these two start to break down. And finally, keep an eye on oil. We had a volatile day yesterday, so definitely showing that there is some negative sentiment in the oil market. So be careful of this. As we know, oil likes to pick a direction and run with it. So such a big candle on the downside. If we continue to see some negativity, I'd be looking. Look at where we're trading technically. I think 51 is obviously a handle significant. Under that, if we get below sort of your 51, 50, below that, and then that opens up some downside potential. So I'd be quite cautious of the oil market today. I wouldn't be surprised if we see a continuation of this move lower, or a test of 50 would get the bulls back into the market and we'll start to drive higher. So keep an eye on this 50, 75, 51 area. If we can break there, that'll be quite significant. Okay guys, that's 9:05. Enjoy your trading day. We have plenty of data coming out, and no doubt we'll see some volatility into this session. So careful in the morning, and keep your ammunition for the afternoon, where we'll see a large chunk of the price action. Thank you very much guys, best of luck, and give me a shout if you need me. I'm in Trading Live.